Welcome to another Mr. James accounting tutorial. This time we are looking at accounting unit 1 of 8, and I'll be doing the entire series of past paper from 2013 right down to 2019. Subscribe, like, comment. We begin by reading what is required first. Part A. Prepare a statement of cash flows for the year ended 31st December 2011 in accordance with IAS 7, IFRS for SMEs Section 7, indicating clearly cash flows from operating activities, from investing activities, and financing activities. Use the indirect method. That is 20 marks. Okay, we take a look at the data provided, and I will then give you an idea of how you should proceed in doing the cash flow statement. The management of Fabric Smart Chemical Limited would like to assess the cash generating ability of the company in order to make plans for the acquisition of new equipment. The income statement is currently showing a reasonable net income. However, she does not think it is prudent to base decisions of this nature only on information from this source. The information below was extracted from the company's books, and we have here the balance sheet. Okay, and in the next slide, we have the income statement. I'll show you in a few minutes. Okay, and now basically what happens is your income statement shows your profitability. That's how profitable. So having a reasonable net income like Fabric Smart Limited does not necessarily mean you are generating enough cash so you can make purchases of new equipment. Okay, and the balance sheet simply shows your financial position at a particular point in time, and those dates that we have at the top. So the statement that really shows you whether you are generating enough cash is the cash flow statement. And if you want to find out if you have enough cash to acquire new equipment, if you have enough cash passing through your business, then what you have to do is look at your cash flow statement and assess that situation. Now, basically, what the cash flow statement will do, it would show you how you got from this position, the movements in the cash from $26,050 to $51,920 within the year. Okay, some of the cash would have come from your operations, some would have come from your investing activities, and some would have come from your financing activities, and some of them would have also gone out in those three areas as well. So, what the cash flow statement will do, it will show us how that happened. Now, let's look at the other piece of data provided. Right, we have here the income statement showing us the net income and the statement of retained earnings for the year ended 31st December 2011. This shows us the retained earnings, movement, what was done with the net income. Okay, so from these bit of data, we are going to compute the cash flows statement. So stay tuned for the workings coming up. We'll start with the workings. First, we have to reconcile the net income. The figure we are interested in is the net income before interest and taxes. What we are given here on the income statement is the net income after the interest and taxes have been taken out here. So the reason for this is we want to show these figures as being paid in the income, sorry, the cash flow statement. So we have to adjust the net income backward. Okay, so we take this figure and we add back the interest on expense and the tax expense, and we'll get the interest before the income before interest and taxes of 133,470. And next we will look at the changes in the working capital. Now the working capital is made up of the current assets and the current liabilities. And the first one we look at is the accounts receivable. And we see changes here, which involve a movement of cash, is an increase of 20,680. Okay, increase in AR is the increases in current assets usually means there has been a decrease in cash or an outflow of cash. Next, we have the merchandise inventory. Again, we see it increase from 401 to 431, so that would be an outflow of cash of 30,000. The same with the, sorry, that's the store supplies. This time it goes the other direction. It changes from 790 to 520. That is a decrease of $270, giving us a cash inflow of 270. Then we have the prepaid electricity, which remain the same, and then the prepaid rent has a increase of $300, so that would give us an outflow of 300. We move next to the current liabilities, the other component of the working capital, and we see the accounts payable decrease by 13,900. So that would be a decrease in cash because it would mean that we are paying some of our accounts payable, and we will look at the note payable separate because that is not an item of working capital. The other one is the insurance payable, sorry, and it decreased from 1990 to 1040, a decrease of 950. So it means we would have paid some, that's an outflow of cash. The other item is the interest payable, which we handle separately since that is not an operating expense. So it does not involve, comes into the working capital. We take the interest balance at the beginning of the year, and and that is interest payable 1160, and we add on the amount from the profit and loss account here 790 with the 1950, and the balance carried down is 120. Minus that, we get the amount paid, which is equal to 1830. Now you can use the same formula to calculate the amount of cash that was paid for any item. And then we do the same thing with the taxes, and we get 44,290. Okay, so balance brought down with 10,460 from here, and then we get the profit and loss account 45,110, and we minus the balance carried down 11,280, and we will get 44,290 has been paid. Now all these figures, we put them together in the to get the net cash flow from operating activities or operations. Statement. Here we have Fabric Smart Jamaica Limited statement of cash flows for the year ended. We start with the net income before interest and taxes of 133,470, and to that we add back the depreciation and we minus the gain on the sale of the asset. Okay, now the reason for doing this is because depreciation and gain on sale of asset or loss on the sale of asset, they do not involve a flow of cash, and they went into calculating this figure. So we have to add them back to get the cash flows. So this and this would give us the cash flow from the net income that would adjust it. Increase in accounts receivable, all the items that we just calculated, and increase in accounts receivable represents an outflow of cash. This section is the working capital, the changes in the working capital where cash is involved. Increase in inventory means we would have paid money out to get the increase in inventory. And similarly with the accounts receivable, we've taken the inventory from here, sold it on credit, and not got any cash for it. So the decrease in the store supplies is an inflow. An increase in prepaid rent, that means we paid more rent than we supposed to. It's an outflow of cash. Decrease in accounts payable, it's another outflow of cash. It means we paid some of our accounts payable. Same applies to the insurance payable. So when we add this column down, we will get a total outflow of cash of 65,580, and we can add these down now, and there is an inflow of cash of 87,680. To that we add back the taxes that was paid. Sorry, that should be we take out the taxes that was paid because that's an outflow of cash, 44,290, and then the interest paid 1830. We just calculated that. You can flip back in the video and look at it, and that will give us our cash flows from operating activities, which is one of the figures that they ask us to calculate. If we look at the investing activities, the sale of the fixed assets given in the notes to the income statement is 12,230. We received for the sale of it. and the dividends paid in the statement of retained earnings, which is 60,000. And when we put the two together, we'll get cash outflows totaling 47,770. You should verify these figures by looking back at the amounts in the question. So we look at the financing activities. First is the payment of the note payable, the balance brought down from the balance sheet. 2010 was 50,000, 59,640. You should verify that, and balance carried down in 2011 is 51,720. It means we have made a cash payment of 27,920. The common stock sold is 12,000 by $5 is 60,000. So that is an inflow of cash, and the payment of notes an outflow of cash, giving you a total of cash flows from financing activity being 32,080. Our increase in cash when we put all three of them together is 25,870. We add that to the balance at the beginning of the year of 26,050, and we will get the balance at the end of the year. Now these two figures here should balance back to the balance sheet, the comparative balance sheet balances. We can now put all the figures together here. We can see the cash flows from operating activities, from investing activities, from financing activities, and the reconciliation. We should note that this balance here would equal the balance of cash at this date in our balance sheet. Part B. For the year ended 31st December 2011, calculate the following ratios for Fabric Smart Jamaica Limited and interpret your answers. 1. The current ratio. 2. Quick ratio. 3. Debt to total assets. 4. Debt to equity. And 5. Net income to total assets. Current ratio. Current assets to current liabilities. In this ratio, the current liabilities is always 1. So we add up the current assets on the balance sheet and we get 580, 330, and the current liabilities is 49,840. We said the current ratio, the liabilities is always 1. So in order to get the figure for this side, we have to divide it, the assets by 49,840, and we'll get 11.6. Now this ratio shows how many times the current assets covers the current liabilities, okay, or how many times the current assets could pay off the current liabilities. A good ratio is 2 to 1. In fact, that's a benchmark ratio, and Fabric meets this quite easily. They are at 11.6 to 1, but this ratio is probably a bit too high, and they just might have too much current assets in their business. Next, we look at the quick ratio, and this is a stricter measure of the liquidity than the current ratio, in that it leaves out the inventory from the current assets and then check to see whether it could still cover the current liabilities. So we have the 580,330 for current assets minus the 431,000 for inventory, and again the current liabilities stay the same. So when we divide this, we will get 3 to 1 this time. Okay, so it shows how many times the current assets covers the current liabilities without including the stock. Okay, that's 1.5 to 1 is considered good. Fabric Smart meets this easily, but they may still be too liquid because they're about twice the amount of the benchmark. That is, there's too much cash in the business. So we are going to look at the debt to total assets. The total debt is 81,560 from the balance sheet, and the total assets is 742,610. And when we record out as a percentage, it works out to 11%. So this shows the proportion of borrowing or debt to the total assets. And what it means is that 11% of Fabric Smart assets comes from borrowing, and that's a very low percentage. And maybe they can do some more borrowing. For debt to equity, again the debt is the same, 81,560. The equity is different from the total assets. The equity is the common shares and the reserves. So that is 661,050, and as a percentage, it's 12.3%. This shows the proportion of debt or borrowing to the capital. It is what you call a gearing ratio. Less than 50% is low geared, meaning the shareholders are providing more funds than the creditors. More than 50% is high gearing, means the creditors are providing more of the funding. The Fabric Smart is low geared at 12.3%. That means the creditors are providing very little funding for Fabric Smart. Net income to total assets. The net income is 87,570, and to the total assets it's 742,610, 11.8%. This shows how efficient Fabric Smart was in utilizing its total assets. They had a return of 11.8% on their assets. As to whether this is high or low, we can't really tell because we don't have any figures for the industry or another business. Whether it's increasing or decreasing, we can't comment on that either because we don't have another year's financial statement. 20. Welcome to another Mr. James accounting tutorial. This time we are looking at accounting unit